Hi everyone, Joe Gentili from Left Tail Risk Advisors. So in this video, I'm going to go through 5 key mistakes I see people make where life insurance planning ends up failing. And these are lessons that I've learned in my role as an attorney representing people in life insurance problems and disputes and failures. And so there's some things that I've seen over and over again that contributed to the life insurance policy ending up in a really bad spot. And so I want to give you these tips so that this way these are things you could look at prior to buying the life insurance policy, or if you just bought a life insurance policy or you have one, ways to look at it to try to manage it to avoid having the problems. So number one, and this is really at the stage of buying the policy, is I've seen people make the mistake of having the wrong product choice or the wrong design for the right product. So life insurance is very flexible. There's a lot of different products out there. There's a lot of different what they call chassis types of life insurance and different ways you could design those products. And it's important that you take the time upfront with your advisor to go through the goals that you have for the policy, because those goals are going to determine what the appropriate coverage is for you. So just as a for instance, I'll give 2 for instances. One is obvious and the less, maybe less so for people. If you have a life insurance need that is temporary, you just want coverage between now and when your kids go to college, or between now and when you retire. That is a temporary need. That should be addressed by term life insurance primarily, because that is the most efficient way to cover a temporary life insurance need. So there are instances I've seen where people have bought permanent life insurance when really term life insurance would have sufficed for them. When you get to the permanent side, permanent life insurance, you have to match again the policy that you're getting to your risk tolerance and the reason why you're getting it. So there's a couple of spectrums I think of with life insurance. So number one, there's the risk spectrum. Certain types of permanent life insurance are much more conservative by nature and less risky. These types of policies are mostly appropriate for people who have a low risk tolerance, or they view their life insurance allocation as part of their financial life that's in the low risk category. Um, or they really, really want to be certain that that death benefit money is there when they pass, because the need for it, like special needs planning, for instance, is just so important. And so for those folks, they're going to want to err towards the side of whole life insurance, guaranteed universal life insurance. And there's other folks that have a higher tolerance for risk. They want to benefit by what the life insurance policy could do if assumptions work out well, not what it's guaranteed to do. And for those folks, maybe variable universal life insurance or index universal life insurance may be the more appropriate choice for them. And then also, like another spectrum to think of is that a lot, as most people know, most types of permanent life insurance have a cash value component and they have a death benefit, right? A life insurance policy can be designed to, on a spectrum from, on the left side of the spectrum, you could design it to emphasize cash value accumulation or early cash value accumulation. And then on the other side of the spectrum is you could emphasize for death benefit. And it's a spectrum. So you can move that dial to someplace in between. So for people whose primary focus is they want to see early cash value accumulation, that is a very different product design than somebody that doesn't really care all that much about the early cash value accumulation, but is really focused on maximizing that death benefit. So you want to match your needs to the policy design. And it's best to work with an advisor that's sensitive to these issues, well educated on the topic, and is willing to take the time to educate you as to these different aspects of life insurance and how to optimize for them. So that's number one. Number two, lack of policy reviews and lack of estate planning reviews. So you buy a life insurance policy in year one, You do it while you have your estate plan drawn up with your attorney. If your life will probably change over the coming decades after you do that. And if you don't review your estate plan to see that annual in your life insurance policies to see if the policy still makes sense for the plans that you have or whether things need to change. For instance, you may get divorced and you may need to change your beneficiaries. Through policy reviews and change of life circumstances, you may see that what you thought was a lifetime need for life insurance no longer exists, or you may see that you don't have enough insurance, that your situation has changed in that regard. And so you want to review your estate plans periodically with your attorney, and as part of that, review your life insurance policies with it. Separately, aside from your estate planning, you're going to also want to review the health of the life insurance policies. This is more important for some types of insurance than others. So for a simpler type of life insurance, like whole life insurance or term life insurance, where if you pay the premium, the policy stays in force, you still need to review the policies. You still need to know what you have, know if there's any like conversion deadlines approaching with a term policy, for instance. But they're much easier to manage and don't require as much monitoring as other types, like index universal life, or variable universal life. There, you want to review those policies to make you're funding those policies according to an assumption, and several assumptions. But one assumption is that the rates of return that the cash value is getting is enough to keep pace with cost of insurance increases that are happening within those policies. And you need to review it every now and again to make sure that you're in line with those assumptions. Because if you're not, you may have to put more money into the policies to make up for those shortfalls. But in any case, you want to know that, because if there is a problem with the amount that you're funding into those policies, it's much easier to correct earlier in the process rather than later. So that's number two. Number three, and this is something I see in the high net worth market, is the policies are over leveraged. People have used premium financing. They've borrowed money from banks in order to purchase the life insurance policy. And anytime you're using leverage to do anything, it increases the risk. Not everybody is aware of just how much risk they're taking on by premium financing a life insurance policy. And I've seen situations where the funding assumptions did not turn out to be correct, and folks were having to put up more collateral than they assumed, and they're looking to unwind these policies at a very large loss because they couldn't afford to fund them properly given the assumption shortfalls. So it's a very dangerous area. I'd really caution people who are looking into premium finance. This is who should be buying it. The person that should be buying it is the person with a very high net worth who can afford the life insurance policy on their own without financing it, but chooses not to. Not because they think that the life insurance policy itself is going to earn a greater rate of return than the cost of the loan, but because they have other areas in their life where they feel like they can get greater returns. So let's say they're very astute real estate investors and they feel like they can get a better return allocating that cash into the real estate markets than they can in life insurance, and they're willing to take on a loan to facilitate that. That's great. That person, it works. All too often, the people I've seen come to me with problems with premium financing are in the situation where they were sold a story that they're going to borrow money at a certain price, at a certain interest rate, and the policy was going to return a greater interest rate than that, and this arbitrage between the two is going to continue for a long period of time, and they're essentially going to get free insurance. And if that didn't play out, they didn't have the money to fund the policy on their own without the loan. That's the disaster scenario that I really strongly encourage people not to get into. So premium financing done incorrectly, really more than anything else we're talking about is a nuclear bomb for somebody's financial life. So be very, very cautious with these scenarios. Okay, number four, people have the wrong coverage amount. That happens a lot. There's a lot of people that, let's start with undercoverage. They pick an arbitrary number that sounds like a lot of money, say $1 million to have for coverage, but it's not enough. It's not enough because let's assume you're buying it to take care of your family. Well, if you got $1 million death benefit and you're spending down 5% a year on that, that's $50,000 a year in pre-tax income that's being drawn from it. Probably not what somebody has in mind as to what they want their family to live on in the event that they're no longer there to provide. So we commonly see people are underinsured. Another way that people get underinsured is they buy life insurance, and let's say that life insurance is to cover an estate tax bill or it's to cover equalizing an estate amongst children because they have illiquid assets. So, they're going to leave the business to one child and a life insurance policy to the other. What may have looked fair when they, or adequate to cover the taxes when they buy the policy in year one. Well, when you revisit the situation 10 years later, maybe the value of their assets or the value of the business has grown a lot and they need to buy more coverage because what started out as an adequate amount of coverage now needs to be supplemented. So they don't have enough coverage. The other end of the spectrum is some people overbuy on insurance. For people who are buying life insurance, and I see this probably most commonly with people that are buying life insurance as a supplement for retirement planning, don't buy more than you can comfortably afford to pay for. So I've seen people where their premium payments are just too high relative to their income. They're sinking too large of their capital into life insurance policies, and it becomes unsustainable. And you don't want to be in that situation where the life insurance policy premiums are so high relative to your income or your capital that it becomes a burden to continue to fund it. Because what ultimately happens with those folks is they deviate from the plan. They have to get rid of the life insurance policy early. That usually results in a loss of capital for them. So you want to avoid that situation. Life insurance really only works and works best when permanent life insurance, when it's held to death and pays a death benefit. So if you're setting yourself up for a situation where you're going to have to bail out of the plan earlier than that, it's probably not going to work out well for you. So it's important to get it right sized. The fifth thing that we see, and it's somewhat related to other things that we're talking about, is I worked with a lot of people whose policy lapsed later in life because they underfunded it throughout. This is not really a problem for people with whole life insurance policies and certainly not with term life insurance policies because, again, as long as you pay the premium, the policy stays in force. There's a guaranteed premium for those, so it's simple. When you get to the universal life side of the world and the non-guaranteed universal life insurance side of the world, IUL, VUL, most policies do not have a guaranteed premium. So you're contributing money to that policy with the assumption that the policy is going to have returns at a certain level. That cost of insurance will be at a certain level, neither of which are guaranteed. And if the policy is missing on those grounds and you're not adjusting as you're going along to make up for those shortfalls, very easy to end up in a situation later in life where the policy either requires a massive cash infusion to stay in force, or the policy lapses in your retirement years. And for some people, they will have paid into those policies for decades and gotten nothing for it, which is a really, really sad situation. So two ways to deal with this is number one, this is most important, understand what you're buying before you buy it. So a lot of people buy universal life insurance policies with the assumption that their premium, you pay the premium, the policy stays in force. They don't understand that the premium is not guaranteed. They don't understand that the risk of the policy being underfunded is borne by you, the policyholder. It's not borne by the insurance company. So if you understand that up front, you may A, decide that this is more risk than you're willing to take on for your life insurance and get a different type of policy, like a whole life policy. Or B, you're going to understand that these policies need to be funded very conservatively. They need to be overfunded, really, to give yourself some sort of buffer in case the assumptions in the policies don't turn out to be correct. If you're funding the policy assuming it's going to earn 6%, but it actually earns 4 over time, you're in for a major shortfall over a long period of time. So that's really important. The other thing, just to go back to an earlier point, even if you understand these things, you need to have the policies evaluated and reviewed to see just where you are, because it's easy to see the cash value going up every year and assuming that the policy is doing well. But that may not be enough, because that cash value has to go up at a fast enough pace to offset those cost of insurance increases that are coming down the line for universal life insurance policies. And the only way really to do that is to have in-force illustrations ideally reviewed by a life insurance advisor, because these problems are much easier to solve if they're caught early than caught later in the process. And unfortunately, as an attorney, a lot of the people that I worked with, they were catching this way late in the process when it was really too late to do anything about it. So those are 5 key ways that life insurance planning fails. Most of these I've come through as my experience as an attorney, so I'm sharing this with you so this way you could avoid these problems by planning for them and getting educated on these issues upfront rather than finding them out in real time. So if you have any questions, please feel free to reach out. And if you found this video useful, I encourage you to like and subscribe. Thank you.